ladies and gentlemen, and others as well, if they will please sit somewhere and join the party. Thank you, thank you. Welcome all, welcome all. Welcome to some new faces that are here. This is our 33rd get-together for the Bretton Woods Committee. And I must say there are several faces here that I've seen around for the last 33 years. It's wonderful to see you all back again. And we're looking forward to many, many more for all of us. You know, the Bretton Woods, no one would be in this room if they didn't know what the Bretton Woods Committee was all about. But it gives me pause these days to think again of what it's all about. And one of the things we have said in some of our brochures is the committee works to demonstrate the value of international economic cooperation and to foster strong, effective Bretton Woods institutions as forces for global well-being. And I would say that over the years, beginning with the Bretton Woods Committee themselves in '45, after the Great War, there has been progress toward international economic cooperation, or internationalization, as we used to call it. And we call it today globalization. And today, particularly today in this year, words were taken from my mouth by the Wall Street Journal's headline this morning, which is, "Globalization is on the decline." Globalization is on the decline. And it's true. We're facing forces that were not here, haven't been here for years. There were periods during the last 33 years when there was moves toward isolation. From internationalization today, there's the spread of nationalization, thinking that looking inward is best for the people of those nations. And many, many nations are directing themselves, or at least parts of them are. Fortunately, they're a minority. But it is something to think about as we go ahead, and to think about the Bretton Woods committees, who are the only international global governmental entities that actually are effective and should be effective in what they're trying to do. So I think our mission is not stale by any means. We'll keep it up. Our programming is not just these meetings, which are a lot of fun for many of us, but we do have things going on. For example, yesterday we had meetings to discuss some new developments with the IMF administration. Bill Rhodes, who's here with us today, chaired that. Is on state contingent debt instruments. Very productive session. And of course, we have dinners from time to time. I had one last night. Many of the people are here today on these issues of financial stability and reform issues. And that was hosted by Eliot, who, not by the way, very importantly, is our sponsor for this meeting today. We're very indebted to Eliot over the years, not just for today, for sponsoring the work, the Bretton Woods Committee. And Joni Swedlin, Joni, where are you? Well, anyway, we owe them a debt of gratitude. And also to SICPA Holdings as well for contributing to our work here. And of course, we're in debt to contributions by our distinguished speakers. We're so glad that every year or whenever we convene something, we're able to attract friends who share our beliefs and share our missions in trying to do something on the field of international cooperation. And you'll be hearing them very soon, because I'll get off. But in the meanwhile, I want to mention that there'll be no breaks no formal breaks. Anytime you'd like a cup of coffee or whatever, or to make a cell phone, you can go in the salon, or if the weather's good, you can go out on the terrace. But in the meanwhile, we're going to just roll along and try to make as much progress as we can. And with that, I'll ask Bill Rhodes, who is a member of our committee's advisory panel, and whom you know, and he knows himself as banker to the world, to introduce Larry Summers, who has been a long time supporter and friend of the Bretton Woods Committee, the Bretton Woods institutions, and all that goes with it. And I should say, a very constructive critic from time to time. And I'm sure he'll have very good and critical words to say to us today. Please welcome Bill and Larry.
First of all, it's a great pleasure and honor to be here with Larry, who's an old friend for, 25 years or so. We were just kidding around before. I think I had the record at one point in time of introducing Larry more than anybody else. I think I was up sort of to 20 times. And we all know Larry. We know what he's done for this country. And I think the idea today is to get his views on the international economy, where the problems are, and his thoughts about what needs to be done. As a starter, Larry, I'd like to hear, the audience would like to hear your views on this sort of semi-stagnant world economy, particularly your views, because there's no one who's talked more about secular stagnation than you, not just in the United States of America, but worldwide. And maybe some of your views also on globalization, picking up on Dick's comment in the Wall Street Journal, because the two seem to go hand in hand.
Let me start with the global economy, and then maybe we can come to globalization, Bill. But before I do that, let me just thank the Bretton Woods Committee and all its members for everything they've done over many years, and suggest that you ain't seen nothing yet. The work of the Bretton Woods Committee in supporting responsible American internationalism has never been more important than it will be going forward. Here's a way of putting it on the global economy, Bill. By one definition, a person is healthy if they don't yet know what's going to cause them to die. And if you use that standard of health, I think you would say the current global expansion is healthy. There are various risk factors and so forth. The global economy is not growing as rapidly as you'd like, but we don't yet see clearly its end and the problem that will bring it to an end. There's another definition of being healthy, which is being able to walk up two flights of stairs. And by that standard, the global economy is in some trouble. The underlying growth rate almost everywhere seems to have substantially deteriorated. There's a very basic thing we teach in economics classes. We teach it in the second or third class. And that is sort of the law of supply and demand. And we teach that if the quantity of apples goes down, that could be because there are fewer apples, or that could be because the demand for apples went down. And then we say to the students, how do you tell whether it's because of supply or demand? And we teach them that if the price went down, then it's probably about more supply. And if the price went up, if the price went down, it's probably about less demand. And if the price went up, it's probably about less supply. So what's happened in the global economy? The global economy has substantially slowed. The underlying growth rate is less than it has been in normal times in some years. Growth forecasts are consistently revised downwards. And at the same time, inflation expectations have largely collapsed. Nowhere in the industrial world is the market expectation of inflation, as inferred from index bonds, anywhere near the 2% target of central banks. And in Europe and Japan, it is probably closer to zero than it is to that 2% target. So when you see collapsing quantity projection and collapsing price projection, it tells you that there's something very important going on the demand side. And that's the kind of recognition that's in the IMF report, which has, towards more, I don't remember exactly the title, but it's the IMF World Economic Outlook is basically about this time, the inadequacy of demand. It's related, in my view, to the other really strong observation about the global economy, and another thing that people have gotten wrong over the last number of years, which is that real interest rates in the industrial world for the long term are now zero. 10-year index bonds in the United States are zero, and they're significantly lower than that in Europe and Japan. And that is the culmination of a 20 to 30-year trend, a trend which, by the way, gives no evidence of having decelerated. In my judgment, the best way to understand that is that a whole range of factors have happened that have raised saving and that have reduced investment, reducing demand, and leading balance to take place at much lower interest rates than was necessary, and creating the very real concern that given the various problems associated with lowering interest rates to or through zero, that the real interest rate necessary for full employment, adequate investment, and reasonable growth is unattainable given the prevailing level of inflation expectations. And that's essentially the secular stagnation theory. And I put it forward 3 years ago as a possibility. And since the time I said it, what's happened? Real growth has been lower than we all expected. Inflation has been lower than we all expected. The bond market declines that we all expected have not materialized. And everyone's revised downwards their view of the neutral real interest rate. Well, I would now be prepared to upgrade secular stagnation from a possibility to a probability in assessing the situation. And I would say finally that it means that we have to do something, that we have to consider policies in a broad category that has been out of our universe historically. Historically, we have thought about demand-side policies to address cyclical problems and structural policies to address long-term problems. And we've identified structural policies with the supply side. It now appears that for the medium to longer term, when markets are telling us that we are not going to get to the 2% inflation target anywhere in the industrial world over a 10-year period, that we need to be in the realm of thinking about structural measures to promote demand, along with the always desirable objective of promoting productivity growth. And that means we're in a very different policy paradigm, I believe, than we've been historically. That's the sort of scientific policy implication. I don't believe you can divorce the rise of populism and the disillusionment with elites, which manifests itself in a disillusionment with global integration, from these economic difficulties and from the sense that these are economic difficulties that we're going to live with for a long time.
Unfortunately, I think a lot of us agree with you on this. Turning to the subject of globalization, and it's not a collapse of world trade, but the WTO, trying to be optimistic, say it's going down to 1.7%. And you have this whole rise of protectionism, which is tied in with populism, nationalism, and that's true not only in the so-called developed world, but you see it almost worldwide. How do you see this trend? Because it would be a major break from what we've seen since 1945.
You know, you can analyze the statistics a lot of ways. There's less, commodity prices are down and commodities are highly tradable, so that makes trade go down. Capital formation is down, capital goods are more tradable, so there's various reasons why services are more of the economy and services are less tradable. You can do a lot of that kind of stuff. But I think there's a different indicator, and I'll tell you the event that brought this home to me more than any bunch of statistics over the last 12 months, and probably in some ways more even than the political developments in my country. I don't know how many of you saw it. Jeff Immelt, the CEO of GE, gave the commencement speech at NYU this year. And in that speech, he basically said, and I'm probably sharpening it a bit, but I am not sharpening it a lot. He said that GE's strategy has shifted from reliance on globalization to reliance on localization. That GE has concluded that you can't be confident that if you produce in one place, you will be able to sell in a different place, and therefore it's concluded that it needs to do much more producing in all the places that it wants to sell, and is redesigning its strategy appropriately. Now, it is hard to think of a more quintessentially global, internationalist-oriented institution than that one, if it's not your former employer, Phil, Citigroup. And if they are making that decision and not making it quietly, but are declaring it as new policy, that is telling you something very broad about how people are assessing the changes in the world. You know, we've seen in the United States a huge change politically on the trade question. You know, I would have tried to find ways to be euphemistic about it, but if we had been talking about the politics of American trade 5 years ago, a central truth would have been, painful to me given my loyalty and allegiance, that Democrats were kind of unenthusiastic and Republicans were more enthusiastic. And I wouldn't have liked that, but I would have had to acknowledge that it was true. In the polling data now, Republicans like trade less than Democrats do. And that is not because Democrats have become wildly enthusiastic about trade. It's been because there's been a substantial change in the allegiance of Republicans. Some of it is that the trade is always something that's done by the president, and so the opposition party always likes it less. And so that's one part of why this is happening. But it is telling you something very fundamental. And I think the dynamic that one has to understand, and that, frankly, I stay up at night thinking about, and that I think a group like this has to really, Americans in a group like this, in some ways everybody in a group like this, has to really confront, is that what they think is that people get together at meetings like the Bretton Woods Committee and Davos and Bilderberg and a variety of other places where the elites convene, and they work out global systems that are good for the elites. They work out more intellectual protection so pharmaceutical companies can get more profits for their medicines. They work out systems so that global banks can go and do what they do in more places more safely. They work out procedures so that capital can move more easily and avoid taxation and avoid regulation. And all of it is working to their detriment. And so they think that in all of our countries, there's a cosmopolitan elite that has more allegiance to its friends in the cosmopolitan elite of other countries than they do to their countrymen. And so whenever they hear there's going to be some international confabbing, they think it's the elite looking out for each other, or it's the elite looking out for its morality. The world's very poor, or people who look different from them, and it's not. Nobody's thinking about the people who live in Akron, Ohio, when international things are happening, and most of what's happening is making it easier for people who are not Akron, Ohio, and making it easier for people who are competing with Akron, Ohio, and they're mad, and they just want to throw rocks at it. And that's the basic dynamic, I believe, of what's going on, and it would be true sort of anyway to some extent, but the fact that people feel like they're not making a lot of progress economically, people feel like their country is not making enormous progress, and so their kids probably aren't going to live as well as they did. That all contributes to their anger, and they suspect that there's a tendency at meetings like this to say that they're just wrong, and we need to just push through past them, or we need to educate them out of their misconceptions, and that doesn't make them feel better. And that's why there is so much anger and I think resistance. And I think we do need a bit of a philosophical reconceptualization of the case for global integration. It needs to be a case that is more about enabling governments to look out for people and represent their interests. It used to be, another way to say it is, the first stage of these debates was, well, free trade's good, it's just really good, and we just got to understand it, and you might not like losing your job, but your sneakers are cheaper, and on balance it works out better off. That was the first stage of it. And they kind of really don't buy that. And the second stage of it was globalization's good for everybody. We really need to have more of it. We know it might not be so great for you, and we know you're mad, so we're going to have a new welfare program for you. And since there are going to be some new welfare programs for you, you should buy into the whole. You should buy into the whole package. Well, and the problem that one might have worked if the welfare programs had been big and generous and expansive, but they weren't. They were kind of grudging and small and afterthoughts. And so that one didn't work. And now they need to think that when there's global dialogue, some of it, some substantial part of it, is about things that are directly better for them. That's why I've evolved on this too. That's why the world has moved towards recognizing that now labor and environment have to be standard parts of trade agreements. And everybody now in the United States now accepts that. We need to have, and this I think will be painful for some, but I think it will be important, a major part of the global integration project needs to be measures that address capital, measures that address tax evasion on a large, I don't want to sharply distinguish between tax evasion, tax avoidance. I mean, some of it is about people who are kind of who are doing things globally and are breaking the law. Some of it is about people who aren't breaking the law, but the law is enabling them to do things which cause them to not pay taxes. From the point of view of the people in Akron, that distinction is really hugely uninteresting. What they think, they don't care whether the EU commissioner does or does not have jurisdiction, and whether it is or is not competition policy, and what the right allocation of power is between Ireland and Brussels. They just think that their paycheck last month was for $800. The pre-tax paycheck was $800, and the post-tax paycheck was $525. And so they don't understand why anybody's saying that Apple pays 1% on its profits. They just don't get it when it's worth $500 billion. So I think we're just going to need to think through this process of global cooperation and global dialogue to make it be about them to a greater extent.
How much of this feeds into this whole sense of inequality? Do you see that as part and parcel of all of this?
Yeah, I think it's a yes. I think it is a significant part of it. I'm probably somewhat more of the view that if people saw their own situations and their kids' situations getting better faster, they would be less focused on just how much money the Forbes 400 was making. So I would tend to frame the issue more through the prism of how much better and how quickly is life getting better for the middle class, rather than frame it primarily through how good is it for the rich relative to the middle class. But both are very much aspects. But I'm trying to highlight a sort of related aspect, which is I think they think it was once true that the rich and they had common objectives, which was to kind of make America more prosperous, albeit the rich would get more money when America got more prosperous. And now I think they think that the rich are not on America's team. They're sort of on their own team global. And that's something they very, very much resent. And I think it's the sense that it's moved to team global rather than America's team that is in some ways as much or more of the problem than that the rich have gotten richer faster than they have. But look, anything that was done successfully that raised the rate of growth of the middle class, that reduced income inequality, all of it is all to the good. But what I'm emphasizing here, because we're at the Bretton Woods Committee, is that I think there's just a question about what global integration is about, what the global project is about, where people need to experience it and think about it in somewhat different terms than they now do, if we're going to succeed in getting them to support it on a continuing basis.
I think a final question, Larry, before we open it up, is what we've seen since the Great Recession, where particularly in the developed world, but somewhat also in the so-called emerging markets, central banks have had to carry most of the load because the government side and the fiscal side, they seem to have been happy in many of these countries to let the central banks carry it. And we've gotten to the point now, it almost seems like we're exhausting that, and everyone says the toolkit is still there. But I think there's impressions, the impression in the markets is that this is getting pretty exhausted. When are the government's going to come in on the fiscal side?
So I've got these views on that question. First, what you have to understand, I believe, and it's sort of very much related to the secular stagnation stuff, is the reason interest rates are so low all over the world is not because central banks decided to be loose. The reason interest rates are so low in the world is that savings propensities rose, investment propensities collapsed, and central banks decided not to let there be a major recession and deflation. And they therefore set interest rates where they needed to be if you weren't going to have huge problems. And so the level of the real interest rate is determined by these more fundamental factors which are forcing central banks to respond. First thing I'd say. Second thing I'd say is I think that it is better to try than not to try, and that the risks of overly tight money tipping us into recession and deflation are much greater than the risks of overly easy money tipping us into inflation and bubbles. But that said, I would agree with you that we are well along the diminishing returns curve with respect to the efficacy of future central banking. And I think the issue that should keep all the world's major central bankers up at night if they want to lose sleep is the reality that if we have a recession, it will require 500 basis points of easing to undo that recession and make whatever allowance and impute whatever value you want to whatever unusual monetary tool you have. And there's nothing like 500 basis points of easing in the fuel tank from here, nor is there going to be any time in the very near future. And, you know, recessions come with a 20% annual probability. I think we've got to think much more aggressively and actively about fiscal policy than we do. And we've got to recognize, and you know, I'm not sure that Jean-Claude would. I wouldn't be sure that Jean-Claude would agree with me on what I'm about to say. But I would argue that, you know, when Jean-Claude was a crucial part of the process that produced the Maastricht Treaty and concluded through some set of analysis that 3% deficits were a good target and 60% debt to GDP was a good target. Whatever the right target was, when you thought the real interest rate was going to be 2.5%, it has to be the case that when the real interest rate is zero, the right target is a more expansive target, just like when interest rates are high, the right target for what size house I can afford to buy is lower than when interest rates are low. And so I don't think we have had an adequate reconceptualization on fiscal policy for the basic change in interest rates and financial conditions that seems likely to prevail for the next interval, and in any event that we can lock in right now by issuing long-term debt. And I think you need to think very differently about debt targets when you can lock in for 10 to 30 years an interest rate of essentially zero. And that, it seems to me, is the core thing that the policy community has not internalized. And when I read that the finance minister of one major G7 country thinks the problem is that we need to rein things back in the G7 because of overheating, I worry about our ability to form consensus on what's necessary. So that's a long-winded way of saying, yes, the emphasis needs to shift to fiscal policy, but there are principled, responsible, analytical arguments. One of them is the one I just made. The other one emphasizes that investment today is an alternative to expenditure tomorrow. And so, consistent with the morality of not burdening our children, consistent with the pragmatic recognition of the importance of preserving credit, I believe that we would do much better to move significantly towards fiscal expansion.
Well, on that challenge and recommendation, Larry, I think we're going to open this to the floor because I'm sure there are a lot of questions for you on this and other subjects. So we have microphones that are passed around. If you raise your hand, give your name and who you're representing. If you're representing any company, you're representing yourself. So can we have, there's a question back there. We can have a microphone.
Thank you. My name is Bob Cecina. I'm from the American University here in D.C. And my question is, and I'll do a little build-up to the question, it's on globalization, and it basically goes as follows. There's no question there's job dislocation, and I would suggest to you that no matter how good the welfare program is, when you lose your job, you lose your dignity, and a welfare program doesn't supplant that. And this is, of course, the vocal minority. The majority...
What's the question?
The silent majority, nobody comes down their stairs on Christmas Day and basically says, thank God for globalization, or I wouldn't have all this stuff under my Christmas tree. My question is, aren't the real beneficiaries of globalization not the elite, but in fact the poor of the world, as suggested in last week's Economist, and as also suggested by the seminal work of Paul Collier, a number of years ago, called The Bottom Billion?
Sure. Yes. Yes is the answer, but the answer is yes, absolutely, and that's why I hope nobody was confused that I was for much more global integration. The problem is that the political process in Europe or in the United States is not prepared to sustain sacrifice for the benefit of accelerating growth and providing opportunity in India or China or Africa. I mean, Adam Smith has a famous, this isn't a new thought, I mean, there's a famous passage in Adam Smith about how much compassion one has for one's neighbor's cut finger and how little compassion one has for a famine that affects 10,000 people thousands of miles away. So absolutely yes, but simply explaining to people, no, you got to understand you lost your job, you got to understand you're losing your dignity, but you got to understand this is really part of a process that's truly tremendous because the bottom billion's on a faster escalator. That is not, I promise you, a winning political argument, as important as it is morally.
Okay, other questions, by the way. I'm expecting someone's going to ask a question about China because we've only mentioned it once here, but do we have any other questions here? Yes.
With Citi, but I'm not representing Citi with this question. The IMF released its report, said we're about 153 trillion in debt. I think you're suggesting that we go quite a bit deeper. Interest rates are nothing now, but will go up. How does that square?
So I'd make these points. First, numerators require denominators. And if you are successful, you can debate whether you will be, if you're successful in accelerating growth, it's the most important determinant of what happens to debt to GDP ratios or debt to income ratios, and that's what you really care about. Second, you say interest rates are low now, but they could go up. But of course, you can lock in the low rate for the foreseeable future in many contexts, and you can do it in ways in ways that are promoting of growth. Do we need to look at places where there are debts that can't be repaid and have more recognition of that reality? Yes, there probably are places and spheres where that needs to be done, though I suspect it needs to be done with very substantial care and caution. And the last thing I would say is I really do, and this would be the IMF has done work on this, and I think it would repay more economic research. I think it really is right that you need to think about debt burdens both in terms of stock and in terms of flow. And if I would argue that your comparison, the one that's implicit in what you're saying, which is sort of total debt to income, that's a comparison of a stock debt with a flow income. And I would argue that better comparisons are of a flow with a flow, debt service to income, or a stock with a stock, debt value to the total value of all assets, including human wealth, future labor earnings. And if you look either at debt service to income ratios or debt to total assets ratios, you will find that they are relatively low by historical. You will not find that they are. I don't want to assert that they're way low, but I don't think you'll find that they're particularly high. And I would argue that those were the better ratios to look at analytically.
I would just add briefly, and one more question. I think when people are talking about a buildup of debt in a short period of time, one has to look at China for the last couple of years to keep that growth rate above 6% before the Party Congress next year, and which is something I think, Larry, we've got to be concerned about. They may have 2 to 3 billion in reserves. We're not sure. 2 to 3 trillion in reserves, but still the way they're building up debt, I think is a concern for the international community since we're talking about debt buildup. One more question I think we have, because Randy's giving me the signal. Yes.
Kotacha, Structured Credit International. I'm not sure I should address you as Secretary Summers or as Professor Summers, but I think probably Professor Summers is more appropriate. As a political economist, how would you address or recommend policies for the new administration coming up regarding getting the angry a stake in globalization? What kind of, you began to hint at it, but you could elaborate further on what kind of things would actually get them back on track, as it were, or would they not?
Very quickly on, I'll come to that in 1 second. Very quickly on Bill's remark, as wise as any aphorism I've ever heard on international financial things was Rudy Dornbush's observation many years ago that things take longer to happen than you think they will, and then they happen faster than you thought they could. And people have been warning about imbalances and growing problems in China for a while. And the Chinese authorities are extraordinarily competent and have shown themselves to be extraordinarily skilled. On the other hand, when I think about China, Rudy's aphorism does come to mind and sometimes worry me. You know, I've learned over the years that whenever anybody says, could you answer this question as a professor rather than as a political official or as a university president or whatever, they're basically inviting me to say something that I will subsequently regret by being too loose. And as I think some of you probably know, all too often people have succeeded with that device in getting me to say something that
I wasn't trying to push you there.
that I will regret. Look, I think that I think that on the domestic side, the right program is one that has the dual and closely related foci of supporting middle class and creating middle class opportunity and overcoming this chronic excess of saving over investment and secular stagnation that I was talking about. I think the single most obvious and important part of that program is decadal commitment to the renewal of the American infrastructure on both the public sector side and the private sector side. Just because Donald Trump says something doesn't make it false. And and he observed in the debate that LaGuardia Airport was a disgrace, and he was right. And it's not the only airport that's a disgrace. I'll give you 3 letters that have no role at all in the American air traffic control system as it now stands. GPS. That can't be as it should be. And one could proliferate examples. And so we need a very substantial program directed at reducing the multi-trillion-dollar liability in the form of deferred maintenance and underinvested infrastructure that we have. Such a program will put people to work in the short run, raise demand, and raise the neutral rate in the medium run, expand the economy's capacity over the still longer term, and ultimately reduce the burden from my children's generation of deferred maintenance first. Second, we need to look very hard at measures that bear on the business environment. And we have done a set of things that almost certainly are not what we could do for the business environment. How can it possibly make sense at a moment when there's various strains in the financial system for us to be thinking about slashing, cutting, limiting, or failing to grow the Export-Import Bank, to take just one example. If you'll indulge me in an analogy I've used before for the state of our tax debate. Imagine that you were running a library and your library had a problem. The problem in your library was that there were a lot of overdue books. You might decide to give an amnesty where anybody who brought back books wouldn't have to pay the fine so that everybody would bring back their books. You might decide to say, we are never going to have an amnesty, so you damn well better bring back your books, because if you don't bring back your books, the fines are just going to keep growing. But only an idiot would say, no amnesty now, we're thinking about one next year. Only an idiot. Now think about the current state of the American debate over corporate tax reform. For 6 years, we have said the $2 trillion are abroad is a problem. We need to do something. We need to find a way to reduce the rate, but we haven't done it yet, but we will soon. It is difficult to imagine a policy that would be more effective in repulsing capital inflows and stimulating investment. And so getting to clarity within the first year on the state of the corporate tax system, it seems to me, would be a second imperative. And a third imperative I will cite is seeking to rebuild by anchoring the priorities and the interests of the middle class, support for global economic cooperation and global economic integration. I think that those three priorities would be valuable ones in terms of rebuilding a sense of confidence in the middle class, and also in terms of accelerating the economy's underlying growth rate. But this will be the last thing I'll say, but I would not minimize the difficulty that, and the challenge that whoever president will inherit. I mean, if Trump were president, the whole set of challenges that I won't try to, for all of us, that I will not try, that I will not try to articulate. But you know, there's on the one hand a very strong instinct in the country for a desperate desire to see successful bipartisanship. And there is also a very strong set of views articulated in the Democratic platform and articulated in large parts of the presidential campaign that are drawing an especially sharp contrast with the views that would be involved in bipartisanship. And so reconciling all of that is going to be a real challenge for leadership going forward.
In closing out, I just have to comment briefly on two things you said. Number one, unfortunately from Mexico, because Rudy Dorn, which was a friend of mine also, he was right. Because when it came quickly. The other thing, the whole question of the here in the United States, we need to look at China, where they've doubled the capital of the Chinese XM and put one of their best technicians, Madame Hu Shilane, in charge. So, while the United States seems to underestimate, the value of the XM, the rest of the world understands that they have to be competitive in this area. Let's give Larry a big hand for coming.